to our inaugural episode of Foliko Teach. Foliko Teach is a program that we've built up to it's not for our experienced users, it's for those that are just learning about the data that we provide, the data that we make. It's also going to go into some concepts that we just feel like covering sometimes. Tyler has years of experience managing a hedge fund. He was a former hedge fund PM, now the current head of research for Cinerai. And so his wealth of knowledge is something for all of us to learn from. But also here at Foliko and Cinerai, we produce a mountain of data from artificial intelligence analyzing millions and millions of news articles every day. But this data can be a little bit daunting at first. How do you make use of it in the best way possible? And that's why we're creating a new series called Foliko Teach, where we can deep dive on each of these topics one by one and give everyone the instruction that they need. If this isn't for you, no problem. Tune in Mondays, Wednesdays, Thursdays, and Fridays for more of our content-driven shows. But today, we want to do a deep dive into the earnings power indicator. This is going to be our first one, and we're going to lead off with one of the most powerful pieces of data that we produce. So earnings power, what is it? Well, like I said, every day we scrape millions of news articles from the internet, and we extract everything that all of these news outlets are saying about 1,100 different companies, our coverage list. And these companies, sometimes the news articles will say, we hate this company. They're doing terribly. Their profit is terrible. They're not going to be able to make their revenue numbers. Their products and the way they're changing it means that their costs are going up. All those things get factored into the earnings power indicator. This indicator specifically focuses on how a company is making money, on its costs, and its profitability. Okay, so everything that these outlets say about that. Now, sometimes a news outlet will come out and say Meta is not going to make its numbers this year. Its revenue is going to be terrible. But guess what? That news outlet has been saying the same thing for the past 10 years, ever since they IPO'd, right? Which was, I think, 2014, 2015. Is that right, Tyler?
That seems ballpark right. The number that came to my mind was 2012, but
oh, all right. But if
May
that
18th,
news outlet,
2012.
Gotcha. If that news outlet for the past 10 years has been saying, Meta's not going to make their numbers, it's going to be terrible every single time, well, our AI algorithms are going to come out and say, we don't trust them so much. For a different outlet that might be really bullish on Meta, again, it might say when this outlet says really good things about Meta, we're not going to trust them as much. But all of a sudden that outlet changes its behavior, its pattern. That's where our AI is going to start paying special attention. And so every day for all these companies, we crunch everything these outlets are saying about these companies, and then we compare it to a 2-year baseline. So for today, if Amazon, everyone's talking about how Amazon's going to make a ton of money, but guess what? 1 week ago, they were saying the exact same things. Their earnings power is actually going to be flat. But if Amazon has everyone saying they're not going to do as great, they're still going to do good, but not as great. Whereas a week ago or a year ago, everyone was saying Amazon is amazing. They're going to make so much money always and forever. It's actually going to result in a negative earnings power score. And so you can see the power of these scores and also the power of being able to compare them one company with another. Just because one company is a media darling and another company like a gas or oil company, which is not going to be popular in news articles really ever, right? Because there's a lot of pressure to say these polluting companies are going to be terrible, right? Well, that baseline means that we can compare this number accurately with media darlings and media outcasts. So oil, like Exxon, compared with Amazon, we can actually compare this number like with like because it's a baseline compared with itself over the past 2 years. So let's start looking at how we use this earnings power health score. Now, I'm going to be bringing up on the screen our tool called Foliko. Pretty soon, everyone here watching is going to be able to take advantage of Foliko Lite, which means that a lot of the same data and screens that I'm showing, you're going to be able to take advantage of for free. If you want to dive into some of the more powerful features, you can always upgrade to the premium experience, but that's not strictly necessary for now. So let's take a look at Rite Aid. Now, what I have here is 2 lines superimposed on each other. The gray line is Rite Aid's stock price, and you can see that it's compared on the right-hand axis here. So $6, $12 per share. Whereas on the left-hand axis is plotted this orange line, and that is the earnings power health score indicator. Now I have here on the top right-hand corner, I can look at this, the 1 day. Okay, so I can see what the score was for that day. I can look at the 1 week all the way out to the 10-week rolling average.
And
Okay.
will you explain? This is a question that we get a lot. So it goes from -1 to 1. What does it mean? What is that exactly? What are those bounds? How did we get there?
It's pretty straightforward. So again, this is the company compared against itself over a 2-year baseline, right? So it is now today forgetting what happened in September 6, 2020. But what we do on that 2-year baseline is we take a z-score for today. And that z-score is comprised of actually three different things. It's the company itself, it's the sector in which the company lives, and then it's the market overall. So all these three things come together. It's a proprietary formula on how we mesh those three factors together, but it does mean that it's not just the score of this company, it's the score of this company in the context of the broader market. So this z-score ranges, and if you're not familiar with z-scores, what that is basically how many standard deviations are you away from what's normal for this company. And then what we do is 3 standard deviations covers 98% of all outcomes, right? Which means that we actually capped it at positive and -3, and then we normalize that around -1 and 1 so that it would make sense. So that means that 1 is the absolute maximum that a company can have. Technically, you can exceed that, but we cap it at 1, which is why when a company will hover at that 1 line, it just goes right there. It is oscillating perhaps a little bit above that 1, but we're capping it at 1 because our models found that there wasn't actually value in going beyond that. So it is always going to be between 1 and -1. Does that answer the question, Tyler?
I think so. It's very important, obviously, to know, your scale and how to read and measure that, obviously. So just want to make sure that we have that very clear.
Yep. Great. So, and to put this into words, forget all the math and the z-score and standard deviation and everything that we just talked about. To put it into words, if a score is at -1, what you would be saying is this company's health score is extremely negative compared to where it usually is. 1, it's extremely positive compared to where it usually is. Okay. So let's talk about this. Rite Aid has had an earnings power health score that was almost at the absolute bottom from where it could be. It was at -0.6. And let's go back to the 1 week. I like using the 1 week as my standard go-to baseline. And then I compare that often with the 10 week to see the overarching trends of how things are evolving over time. So 1 week baseline, you can see that we're really hitting some negative numbers here at the beginning of 2022. And this really caused a weight to drag down that Rite Aid price. However, the Rite Aid price went beyond that negative health score, as the health score has actually been improving between early 2022 and now. In fact, we're almost at neutral health scores for Rite Aid, which means, and you can interpret that as Rite Aid is sitting at about where it has been for the past 2 years when it comes to the way it's earning money. Now, this has been pulling the health of the stock price of Rite Aid upward. And you can see that one of our biggest positive trades that we've made was on the earnings for Rite Aid as they were releasing. Was it Q1?
Yeah, I believe Q1. I believe it
Q1
ran,
earnings.
about
It was
33% in 4 days.
Yep. It was this movement right here, I believe.
Yes,
They
that
released
large
earnings in
divergence.
June. Yep. So that leads us to our next point is this is all the math and all the numbers of how we're making these health scores, but what's more important than that is how do you actually use it to make money? And that's why I wanted to hone in on Rite Aid, because this is a great first example of how we can use this indicator to make money. And I want to jump to Tyler to explain that a little bit deeper of what is this system you've started noticing and building out from earnings power?
Yes. So I have a background in fixed income. Coming up, one of my first bosses is he's a legendary technician. If you've worked on the buy side, you've read his morning note. So I came up with a very technically inclined bias. I like charts. I think they're a roadmap. They're a way of seeing where the bands on the outcomes could potentially be. They're not a measure to just be trading on by themselves, but they are a great risk management tool. So I come to Foliko and Cinerai with that background. And what I started to see is As somebody who looks at RSI, relative strength, for example, and I'm a divergence trader, so I'll look for RSI not making new lows while price is making new lows, for example, to trigger a long, and the other and vice versa. That's how I found my natural gas trade. But so what you'll start to see occur is these divergences between earnings power and the price. So these large gaps are generally, we have found, predictive of mean reversion. So we would expect Neo to take a dump. I believe they report earnings tomorrow. We took the 17 and a half puts because of this bearish earnings divergence. So this is from a systematic technical standpoint. I like to look at it this way. I think the technical community could potentially really appreciate and trade with stuff like this, because to me it's just AI driven RSI essentially on earnings, which gives us a large edge on earnings day.
And so I want to deep dive and really nail down the definition of what is meant by a earnings divergence, and actually pepper you in with a couple smaller, more detailed questions if you don't mind. So what is meant by earnings divergence is that the orange line is decreasing at a rate that the stock price is not matching.
Right.
Is that right? Or
yes.
Or it could be the earnings power is really taking off and the stock price is staying level, or the
Yes.
stock price is going down.
Yes,
Now,
and the wider the spread, the better. Like, for example, this one's okay, but the best ones are, because there is that gap there. But what would make me more excited is if price had been rallying the whole time. So that's the thing we think about. I tried to go back this morning to show like the good ones, like Netflix, like here, let's see. They reported today. But last quarter, we were able to very successfully predict. That's not cool. Sorry, guys. Yeah, so we were able to predict. This is Casey, and they don't look as good in hindsight, but basically, the bigger the divergence where you can get earnings power negative while price is positive. Okay, so there we go. That would be a perfect one. So price has run all the way up here, and earnings power is all the way on its butt down here. So
that is when you traded Kingsoft, is it not?
I don't remember. Well, no, because we got a great long and a great short. Like, we had a huge earnings squeeze, and then on the back of that, we took, that one was kind of tricky. But I just wanted to bring that up because that's the best in pictures. This is the best one I could show you, where price just took off and earnings power said absolutely not, and earnings power took the W big time.
Great. And essentially, if we were to put that into words, it's that the perception of the company is taken off to the positive upside, but they have not necessarily earned that.
Yes.
There's not really a strong backing to that perception, so they're going to be dragged back down.
Okay, so I do see one question. I think we will take questions on today for today. I don't know how we're going to do it in the future, but I think it's important that if you have questions on the stuff we're teaching, please ask it. If we don't answer today, we will figure out a way to answer it. We'll make you a special video, whatever we need to do, we will get it done. So back to you, Travis. What does a score of 0 mean? So like if the earnings power is on 0, I think you touched on this before a little bit. That just means average for 2 years. Is that correct?
That means that the company is holding, in this health score, it's holding at about how it's been for the past 2 years.
Okay.
Exactly. So now, question for you. What is the period that we should be looking at here? So what if you have a big earnings divergence? Earnings is being released 1 week from today, but you're noticing that it's starting to come together a little bit.
Yeah.
Like,
So
what are some of the edge cases of how you treat this?
Yeah. So you'd be, in my opinion, what's interesting is I take this as losing strength on the signal on the 1 day, but what we're going to show is we're actually capturing momentum to close out this show. This is going to be a bit of some Cinerai Quanti stuff here because we want to show, okay, you learn the basics. Here's where you can go with this, and it's really cool. And the back test is actually incredibly profitable.
So shall we jump to that?
Yeah, absolutely.
All right. So what I want to point out is that the key here is that there's a strong relationship between the directionality of these two lines. In other words, you can't just look at earnings power and say earnings power is at this level. I'm going to trade it now. Or earnings power is changing this quickly. I'm going to trade it now. You have to look at the interplay between these two lines. Now, there's two different dimensions that you could be talking about. There's the absolute level. So you could say that right here, my earnings power is minus 0.82, 0.082. And you could say my stock price is 6.85, right? That's actually not a very useful way to look at it. What you want to be looking at is the delta over a specific time period. So you want to be looking at the slopes of these two lines. That's where our models are picking up the best straight trades. Now, when it comes to Tyler's divergence trades, that might be absolute values, but I think you're looking at a lot of slopes there too, aren't you, Tyler?
Slopes, and it's the one versus the other, right? Like if you took price off the chart, I'd have nothing.
Yep. Yeah, if you're not looking at the relationship between these two lines, you're really not getting much of anywhere. So what I wanted to do is I wanted to bring everyone a little bit of deeper analysis to say, all right, if the stock price is changing this fast and the earnings power is changing this fast, what on average has been the outcome? Because guess what? We have this data going back several years. So we can keep track of all the hundreds of times each of those situations have happened and start mapping out what the expected price change is going to be. So what we're going to see coming up here is some pretty complex Excel magic, but let's go with it, see where we end up. So what I have here, and I want to show you where this analysis is coming from, and you start, if you know Python or R, you could start putting some of this analysis in yourself. So what I have here is two data frames, one where I'm comparing all of our health scores and the other one where I'm comparing historical price changes on these stocks. Again, 1,100 companies going back. For this analysis, we're just going back to 2019, January 1st, 2019, just because that's where our stock price data comes from. And what I have here is I'm comparing two things. I'm comparing the past stock price change. So where has the stock price been over the past week? And I'm also comparing the past earnings power change. Where has the earnings power been over the past week? And I'm then projecting that forward 2 market days forward. So this doesn't mean weekend or it doesn't mean holidays. Labor Day would not be included in this. This would be I have my closing price on Wednesday, and then what is the percent change between now and my closing price on Friday? Okay, so 2 days later. Right. And you can just see how this analysis is going. What I'm going to do is I'm going to create a cross tabulation. That means on one index, I'm going to be putting the earnings power change, and on the other index, I'm going to be putting the past historical stock price change, each one over the course of a week. And then each of the values is going to be that stock price change. Let's take a look at what this actually looks like in Excel. So you can see here, let's take one cell, for example. The top bar is going to be that change in earnings price, again, over the past week. So this means that earnings power has changed by 0.7 over the past week. 0.7. In other words, that slope is extremely steep on the downside over the past week. Stock price is going to be here on this axis. So this means that we've had a drop of about 2.5% in the stock price of that company over the past week. All right. Those are our cutoff points because of once you go beyond these two numbers, you start getting to a lot of tail events, a lot of outliers and things like that. So we've tried to make this data as relevant as possible. Now here in the numbers, in fact, what we can do to even help in interpretation here is actually just translate this out to percentage. This means 2 days from now, the stock price on average, for every time these things have lined up, on average, the stock price has gone down by 4.3% over the course of 2 days. Now you'll notice that I have here some conditional formatting. In fact, let's reset this. So if we zoom out and we see this map, over here on the right, is going to be really steep upward slope of earnings power. That earnings power is very quickly charging upward. Over here on the left, earnings power is very quickly declining. Over on the top, stock price has been going down rapidly. On the bottom, stock price has been going up rapidly. So on this bottom right-hand corner, stock price is up rapidly, earnings power is up rapidly. On the bottom left corner, stock price is up rapidly and earnings power is down rapidly. Okay, so these are our converse corners and these are our sympathetic corners where both lines are moving in tandem. Now you'll notice if you're looking at the colors, just take a view. Where are you seeing concentrations of red and green? Well, you're not seeing a lot here in the middle. In fact, in the middle, it's all really relatively blank. In other words, you're not seeing much of a movement there. This conditional formatting is going to be picking up movement. The more red it is, the more the stock price will go down over the next few days. The more green it is, the more the stock price will go up over the next few days. So up in this corner, you'll notice a lot more red. Don't take my word for it. Take a look for yourself. Up in this corner, you're noticing a lot more green, especially if you compare the two corners. Down in this bottom left-hand corner, a lot more red, a lot more green. And what this means is it's quite interesting. A lot of these things end up being surprising to us. It's not like we come in with a hypothesis and we beat the data up until it says what we want it to say. But what we're showing here is it doesn't really, if the stock price has gone up rapidly or down rapidly, either way, if that earnings power is down, you're going to expect negative price movements over the next 2 days. If the earnings power is up, you're going to expect positive price movements over the next 2 days. Let's zoom in our relative comparisons. By doing this, I'm just going to select a subsection of the chart, and I'm going to do conditional formatting just within that chart. And even within this microcosm, you're going to notice similar effects. Now, what I'm seeing is a lot of red in this bottom left-hand corner. Let's zoom this out and get a little bit less specific on that. A lot of red in this corner, a lot of green in this corner. More red on this side, more green on this side. So small, it's hard to select. More green on this side. So what we're showing here is that earnings power is a powerful tool to predict what the future stock prices are going to be. If that slope is sharply going to the upside, that shows you that this stock price has some potential to go sharply upward. All right, Tyler, thoughts on this? Am I explaining this the right way? Does it make sense the way that we're talking about it? I need you to gut check me because data just sometimes clicks for me. I made this and I want an outsider perspective on how this is going.
I certainly hope so. I mean, it made sense to me. Basically, what we are finding here is that we are accurately measuring momentum, which is a factor that has been, proven to exist. I could, dump a mountain of white papers on you and academic papers proving, showing studies that this exists. So I think this is very cool that, we have a way to bucket basically best and worst of momentum, of our own momentum. So this is probably something, I just saw this analysis 15 minutes ago for the first time. So this is something we're going to have some things for you. We might actually just send out what's in the top bucket, what's in the bottom bucket. Are there companies or sectors that hold this pattern stronger than others? No, this was our all up. This is our all up coverage list, right? So there's no magic, right? You didn't remove the energy sector or anything like that, right? To my knowledge, this is whatever our 1,500 names on our coverage list, right?
Well, this is the whole list, but I think it's an interesting question because it comes back to things like we've shown with ESG. So ESG, this chart, this kind of pattern would matter for energy companies and materials companies, basic materials companies, right? But it wouldn't matter as much for, say, technology or financial services or something like that. Is this relationship stronger in certain industries? That's absolutely something that we can explore. I appreciate the question. I don't have the answer ready-made for us right now. It would take me a few steps in coding, and that'd be really boring to watch me. But we can absolutely take a closer look at that in a future episode. So thank you for asking the question, AI-powered swing trader. And we can get back to you on that. All right. So this leads us through earnings power. There are a mountain of opportunities to take a look at now. So what if you look at 7 days in the future? What if you look at 90 days in the future, 10 weeks, right? So there's a lot of different ways to slice this data up. We've been playing around with this data in its final state since February of this year, which means that every day we're still discovering new and powerful ways to use and trade this data. And that's why I think it's important for us to communicate on this YouTube platform and trade these ideas with each other and say, hey, I noticed the following thing. And as you pay it forward through those kinds of discussions, you're also going to receive a lot of additional knowledge because people are like, yeah, that works. But also, I tried this. And that's how we can double down and go even further. And that's why we're taking a community view to this. There's too much here for just Tyler and I to actually exploit and improve our own portfolios. We want to hear from and interact with you. So drop us a line, let us know your observations, come in and join us on the live shows, ask questions in the comment section below. We'd love to interact and dialogue with you further. AI powered swing trader, wherever you're at, we're going to give you an answer in the comment section below over the coming days, so you can look for that. Everyone else, thank you so much for joining us here on our Foliko Teach, and we look forward to joining you on future episodes going through this. If you have questions about the data you're seeing in our Foliko Lite website or Foliko Premium, drop them in our comment sections, and they will become the subjects of future episodes. Tyler, last thoughts?
No, I'm looking forward to this Tuesday. I think we're really going to make sure that everyone who's using Foliko Lite has some basic knowledge and understanding of how to use the tools, and from there it's pretty much endless.
In the days to come, we are going to be putting links to Foliko Lite in the comment section below, so make sure you look for that, and we will see you soon. Bye all.